Good morning, good afternoon, everybody. Sorry we're starting a little bit late today, but we got some good content for you guys. I'm going to jump into it pretty quick here. Thanks for joining another Rethinking Your Retirement workshop. I'm the host, Nate Hare. I'm the executive director of Directed IRA and Trust Company. We'll talk about a little bit about what we do, but we're here to really just talk about different types of strategies that you can use when it comes to note investing, and specifically note investing within a self-directed retirement account. I have a special guest with me too, somebody I've known for over a decade, who not only is a great note investor, he's a great investor in general. And the funny thing about him is he is a former rocket scientist. So when you get that type of brain, an engineering type brain, a rocket scientist type brain, they always come with unique angles and things that most of us don't even think about because they're very numbers driven. And a lot of times they make great investors and even great note investors. So I'm personally excited to watch Bob Zachmeier present for us today. But I'm going to start it off and just do a quick little introduction. I'll have one case study of my own, shouldn't take more than about 10 minutes. And then we'll jump over and then I'll bring Bob Zachmeier onto the program. So let me share my screen for you guys. Let me know if you guys cannot see that. And then I always remind people in the chat, you guys can either talk with each other, you guys can put your questions in the chat, you can put your questions in the Q&A, and we're going to get to questions at the end. I can take questions while Bob is presenting as well, but and we also will have our contact information if you guys want to follow up with us afterwards if we don't get to your question right away. So let's just jump into it. We're going to talk about small IRA note strategies in self-directed retirement accounts, but I got to cover some basics first, just for anybody who is new. And anybody who's new, thank you guys for joining us. My name is Nate Hare. I'm a certified IRA services professional. What the heck does that mean? That just means I know a lot about retirement accounts and specifically self-directed retirement accounts. You got to pass an exam by the Banking Commission. And it's just basically says I know a lot about retirement accounts in general, but my background is actually in real estate and lending. That's where I got my start in 2002, was working for several different mortgage companies. That's where I got my interest in real estate. So I've always had this love and, just passion for real estate in general. And it was about in 2012 when I finally learned by luck that you can start investing in real estate and notes inside a retirement account and all the wonderful things you can do in a retirement account because retirement accounts pay no taxes. So for the past 11 years, I've been teaching investors of all types how they can use self-directed retirement accounts to invest in not only real estate, not only notes, but investments into syndications, cryptocurrency, commercial property, land. There's all sorts of investment opportunities when it comes to your retirement account. And I'll talk a little bit about more about that and what we do at Directed IRA. First, before I get into it, just a little disclaimer that everything here is for education purposes only. We always encourage you guys to consult with your financial professionals before entering into any type of investment. I am not licensed to give you investment advice. We are not financial advisors here at Directed IRA. We work a little bit different than your traditional custodians like Fidelity or Charles Schwab, Wells Fargo advisors. We manage retirement accounts, but we manage self-directed retirement accounts. And what does that mean when we talk about self-directed retirement accounts? Well, self-directed retirement accounts come into play, and they're becoming more popular nowadays for people that want to invest their retirement into what we call alternative assets. Most people are familiar with traditional assets. Those would be things like stocks, bonds, mutual funds, ETFs, REITs, CDs. Those are traditional type investments, and you know where you can find them. You find them at your traditional brokers, your licensed securities brokers like a Fidelity or Charles Schwab. But ever since IRAs were created in the mid 70s, you've been able to invest in the same things, and it goes outside of just the stock market and outside of Wall Street. You can invest in all sorts of things. When it comes to the IRS tax code, the IRS does not tell us what we are allowed to invest in with our retirement accounts. They only tell us what we're not allowed to invest in, and the list is really short. The only two investments you're not allowed to hold in a retirement account is life insurance contracts and collectibles. That's it. So there's a lot of investment opportunity out there available to us. And self-directed IRAs are the vehicle that you need to use if you want to invest in rentals, fix and flips, commercial property, multifamily, private equity, private stocks, syndications, promissory notes, which we're going to be talking about today, and more. The only big thing that you got to remember is that when you invest in alternatives through a company like Directed IRA, we don't have the investments to sell you. That's not the nature of our business. What we allow you to do is you pick the investment that you would like to hold in your retirement account. We'll sign off on the investment. We'll administrate the investment. That way, the investment gets all the tax benefits your IRAs get, whether that's a tax deferred growth type of IRA or a tax free IRA like a Roth or an HSA or even an ESA. Most of our clients have IRAs at both places. I'll never tell anyone that they should have one IRA here and not an IRA somewhere else. It's really up to you as to what you want to invest in. But just understanding that you have more investment options is powerful information, and it's not something that they teach us in school. So we're very passionate about teaching people that they just have more options when it comes to their retirement assets, and alternative assets is the fastest growing investment option over the past 2, 3 years. Last year, we saw the biggest increase in alternative investments in retirement accounts that we ever have. More people are looking for alternatives when it comes to their retirement assets, and there's a lot of benefits to having alternatives, and I'll kind of go over those here in a second. But why are notes and loans attractive as a self-directed IRA investment? First, for anybody who's really new, let me just explain to you what a note is. A note is just a promise to pay. Most people are familiar with notes when they go into a bank. When you walk into a bank and you need a loan for the house that you live in, you qualify for a loan. But the actual document those loan terms reside on is a promissory note. Okay? Banks do it every day. Banks make a lot of money, by the way. So there's a lot of investors that take that same approach. They say, I like real estate as an investment, but I don't want to deal with toilets, tenants, or ownership headaches. I want real estate, but without the renters. That's why so many self-directed IRA investors like the option of holding notes in their retirement account versus owning real estate. You can do both, but there's some advantages to owning notes, and a lot of it is just less work and less hassle. So, what would be the benefits of owning a note inside of a retirement account? Well, the biggest benefit, the biggest thing I think people look for is it's passive. Like I mentioned, you don't deal with toilets, you don't deal with tenants, you don't deal with ownership headaches. You own a note. That note can be secured by real estate, but really, who's doing all the work? Usually, all the work is being done by the borrower, the person you lend to. That's the person that's dealing with all those headaches. All you do as a lender is you sit back and you collect interest payments. Now, there's some risks and rewards to that, but the main thing is it's passive. You don't have to do a lot of work when it comes to ownership of real estate because you don't own the real estate. You just own the note secured by the real estate, just like a bank. Notes offer an opportunity to diversify your overall portfolio too. Now, this goes outside of just note investing. I would just say alternative assets in general give you a better opportunity to diversify your portfolio. And I say this specifically because a lot of people get confused. They think, oh, I have to be a real estate investor to use a self-directed IRA, or I have to be a note investor to use a self-directed IRA. 80% of our clients at Directed IRA, we've got about 15,000 clients. I would say 80% of our clients are not investors by trade. They work 9 to 5 jobs. They still work their W-2 job. They just have found that self-directed IRAs and alternative investments have given them either a better return, maybe safer investments. They don't have to wake up every morning and look at CNBC to see if their stock went up or down. But with notes secured by real estate, notes are secured by something that's tangible, and we'll talk a little bit about that as we go through. Notes are predictable, and I'll talk a little bit about that too. Me and Bob will both talk about that because with a self-directed IRA note investment, oftentimes you're negotiating the terms. You're negotiating the interest rate. You're negotiating the maturity date on the loan, which means when's the loan supposed to be paid off. You're negotiating whether or not your IRA would get an equity piece in that loan. You're negotiating as the IRA's fiduciary, you're negotiating the terms. So the reason I like note investing, and I primarily do note investing in my IRA, is I don't have to wake up in the morning and look at CNBC. I just have to look at the first of the month to make sure my borrower made a payment to my IRA or my HSA. That's all I have to do. And I know exactly what that payment's supposed to be because I negotiated the terms with the borrower. So that's just an example of just a simple interest loan, but you can get creative when you create your own notes. And we'll talk a little bit about that. And Bob's going to dive into some stuff that I'm really excited about too. But the biggest thing with IRAs you want to remember is that IRAs are not taxpayers. Traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, 401ks, they're tax exempt trusts. So whatever you invest in, remember all the income that's generated from that investment will not be taxed while you invest it in the IRA. So investments in an IRA, the money grows a lot faster than money you invest as an individual, because as individuals, we pay taxes on an annual basis. IRAs don't pay taxes annually. And if you utilize some of the IRAs that we have here at Directed IRA, like a Roth IRA or a Roth 401k, not only is the growth tax free, but the distributions are tax free. This is why so many people like lending in an IRA, because lenders typically, if you're lending outside of an IRA, it's a great investment. It's still passive, it's still well diversified, but you pay taxes on all the interest payments that you get from your borrowers. You do those same strategies in an IRA, you pay no taxes whatsoever. And if you use the right IRA, you pay no taxes on distributions as well. Well, with self-directed IRAs, what I always tell people is just invest in what you know best. Self-direction is not for everybody. I would say it's more for the entrepreneurial type of investor that wants to take a little bit more control over their retirement assets, invest on their own terms, or they have some deal flow or they have some investment experience that they want to apply to their retirement account. So if you understand real estate, if you understand a little bit about note investing, you'll probably make yourself better returns in the long run doing what you understand inside of an IRA or a 401k. So here's the types of plans that you can self-direct. And I'm just going to go over this real quick and then I'll turn it over to Bob. There's 7 types of plans that you can self-direct and buy alternative assets and do note investing. Okay. Now, all of these accounts work the same when it comes to processing investments. They just work differently when it comes to making contributions and taking distributions. I'm not going to cover all that right now. We've got other classes on that. But if you just take one snapshot, take a snapshot on the 7 types of accounts that you could self-direct. Traditional IRAs and Roth IRAs would be your personal plans. Those can be self-directed. Those can own real estate and those can own notes. The same investments can be owned in your employer plans. That would be your SEP IRA, your simple IRAs, or even your solo 401k. Now, those are specifically for people that have self-employment income. And for people who have self-employment income, you've got that added benefit. I just say it's another page on the menu that you can choose from when you're thinking about self-directing. And then we also have accounts that are not IRAs, but they are tax exempt. Accounts like the HSA, the health savings account, and even the education savings account. These are not retirement accounts, but these are accounts that can be self-directed. And my one case study I'm going to go over is on my own HSA investment. And I'll talk a little bit about that. But these are great accounts if you're looking to self-direct and use the money, the profit right away, tax-free, to pay for qualified health expenses for you and your family, or qualified education expenses for your kids or your grandkids, education expenses all the way from kindergarten through college. When you look at these plans, what I always tell people is I've never met anybody on this planet that only needs one plan. Most people need 2 plans, 3 plans, 4 plans, depending on how many kids you got. You might need 7 plans. I have a client that has 15 plans. They've got plans for themselves, their spouse, their kids. The kids have kids, so grandkids. I've seen even clients go above that, but there's not a limit on how many accounts you can have. I would say you want to have at least more than one, depending on what you're doing, because these are not taxpayers. You're going to give less money to Uncle Sam, provided that you're using these accounts to host a lot of your investments. Okay. So what are some note strategies for small self-directed IRAs? And I'll kick it over to Bob here in a sec. But these are the most common strategies for people who have small IRAs. The number one way that you can take small IRAs and invest them into larger investments or larger notes is just through partnering. Partnering is easy. Partnering just means I'll take some of my Roth IRA, my wife's Roth IRA. Maybe I have my kids on payroll. They have Roth IRAs. Maybe they're under the age of 18, so I have education savings accounts set up for them. And maybe if I have a high deductible health plan and I've got an HSA. Those are all individual plans and those act like individual buyers. The easiest way for me to get my money moving all together is by partnering those accounts together. Okay. You can partner as many accounts as you want together, and you can partner with other people's IRAs or even personal funds when it comes to creation of a note. So partnering is probably the most common way for you to take small IRAs and invest in the larger things is just by grouping IRAs together. There's other things, and we won't talk too much about these, but bridge loans is another small IRA strategy that I've seen a lot of clients use. Second mortgages and notes. Obviously, there's a little added risk to second mortgages, but I've seen a lot of clients make a lot of money doing second mortgages versus first lien mortgages. Partial notes, which Bob's an expert at, and I'll let him talk a little bit about that. And joint ventures is not technically a note, but I've seen a lot of investors use joint ventures as a way to take a small IRA and involve maybe somebody else with a bigger IRA and invest into, a larger project. I'll just give you Jim Ingersoll's a great friend of mine who does this a lot. And I know Bob knows Jim Ingersoll. He'll take a $10,000 HSA and partner it with somebody else's $90,000 Roth IRA, and they'll buy a $100,000 house. But as part of the joint venture agreement, they might split the profits 50-50. So those are some strategies that we'll talk about on future programs, but we're going to really dive into partnering. And Bob's going to talk about partials and some of the things that he's done with his IRAs. Okay. So let me just go over a quick case study of my own. And this is just a fractionalized note. Okay. I'm just going to go over this real fast. And if you guys want the PowerPoint on this, just shoot me an email at the end and I'll send you the email on this. But this is really, really basic. Okay. First, how do you self-direct? You got to set up an account with a self-directed IRA custodian if you want to invest in notes. You fund your self-directed account by either transferring some money from another IRA, rolling some money over from an old 401k, or just making a contribution. And then 3, the self-directed part is you find the investment. You tell us what the investment's going to be, or you tell us who the borrower is going to be. And you do that by giving us a copy of the promissory note, showing who the lenders are, making sure that your IRA is vested properly on there. This is something that we walk you through, and just filling out a form with us called our direction of investment form. Okay, so you open the account, you fund the account, find the investment, and we walk you through the rest. So here's one that I did real quick. It was a small loan amount to begin with. It was $55,000. This real estate investor approached me at an event. We had run into each other. I had known her for a couple of years. He needed $55,000 to buy this eyesore of a property in a rough part of Houston. Okay. So I had my HSA sitting with only a couple $100 in there at the time. It was less than $1,000. I just used it for a root canal, but the HSA was a powerful tool for me that I still use today, because for anybody who's got an HSA, you guys know this. When you make contributions to an HSA, you get a tax deduction. So it's tax-free going in. You can invest in HSA. You can partner it on different notes, like I'm going to show you here. All the profit to the HSA is completely tax-free. And you don't have to wait for retirement to use the profit. You could take the money out the very day you make profit, and it comes out completely tax-free on a distribution, provided you use it for qualified health expenses. So a self-directed HSA, tax-free going in, tax-free as you invest it, tax-free coming out. So I had $500 in my HSA. I added $50 to it because I wanted my HSA to just be an even, clean 1% note or interest in the note. Okay. I went to 4 other people that had a total of 7 IRAs that all had just cash sitting around, laying around doing nothing. Now, the important thing to this story is those investors were not disqualified to me. It wasn't myself, it wasn't my wife, it wasn't my kids. It was just people that I worked with that had extra IRA cash lying around. And I literally just went around and said, hey, does anybody have some loose change lying around in any of their IRAs that would like to partner with me on this note? Okay. Found 7 different IRAs.
You can't see your screen.
Oh, can't see my screen? Hold on.
And unshare it and then make sure.
Sorry, guys. Give me one sec. Okay. Can you guys see my screen now? Bob, can you see my screen? Okay. Sorry about that, guys. So this was just a simple interest note. I negotiated the terms with the borrower. Okay. I put the deal together. But here's the thing is I negotiated 2 points up front and 12% annually for 1 year. Okay. Now everybody on this deal got 12% annually. But since my HSA was the only account that I had involved, I didn't have personal cash in, I didn't have any of my other IRAs in. I actually negotiated that the 2 points up front would be paid directly to my HSA. Now, if you guys understand real estate, the 2 points is not based on my 550. The 2 points is based on 55,000, which you do the math, that's $1,100. And I negotiated that it was paid at closing. So this was a loan that was secured by real estate. We just call it a fractionalized note. Okay. How the note was drafted is it just had each IRA listed with their ownership percentages. I just did 2 here just to make it easy. But my HSA had $550 invested into it. It had 1% of the note. And then we had 7 other IRAs listed with their ownership percentages. It's not a multiple liens. It's one lien on one note. It's just a fractionalized note. Every time the borrower paid a payment, a monthly payment back to directed trust company, that payment was split pro rata to the accounts involved. But remember, the points were paid up front at closing, so the points got paid to my HSA. And I made sure that was okay with everybody else involved. They didn't have the deal. They didn't bring the deal to the table. They were actually happy that I took their money from making 0% to making 12%. So closing, my HSA received a check from the title company for $1,100, which is a quick 200% return. But why did I want to do this in my HSA? Because I can use that $1,100 the very next day, okay, or the same day, okay, to pay for qualified health expenses like acupuncture, holistic medicines, prescriptions, doctor's visits, eyeglasses, root canals. I can use that money right away, and I didn't have to pay any taxes on the profit. And I got a tax deduction for the money that I put in there. So this is just a quick example of what I've done with a small IRA or HSA. Key points to remember: you can't loan money to yourself or another disqualified person. We've talked about this on previous programs. Me and the borrower set the loan terms. That's another creative thing. That's another thing I like to talk about when we talk about notes. And IRAs can loan money secured or unsecured. I don't do unsecured notes personally, but you can do them. You can negotiate terms on unsecured notes, but remember, I always find that it's better to have it secured by something real and tangible like real estate. So if you guys want a copy of this, I'll give you guys my PowerPoint at the end here. But Bob, I want to bring you on. I took a little bit more time than I needed to, but I want to get you on here. If you want to unmute yourself.
Okay, I'm unmuted.
Yeah, there you're unmuted. You want to share your screen and then take over here? Let me stop sharing mine. And the show is yours.
All right, can you see my screen?
Yep, I can see it. Give them a little introduction on who you are and all that, because I said that right? You were a former rocket scientist.
I worked at Raytheon and Texas Instruments in the defense business for 22 years. And yeah. I quit that job in 2002, and now I have actually been a real estate agent for 22 years. So I've been a real estate agent just as long as I was an engineer. I make a lot more money now as an investor than I ever would have made being a rocket scientist. So that is, if you're interested in reading, I've got 6 books I've published. If you want to keep up with what's happening nationally in the market, I have a nationally syndicated radio show on iHeart. And my wife and I currently own 90 notes. We won't quite make it by the end of the year, but sometime first quarter next year, we will actually surpass 100 notes that are paying us every single month.
That's
So
that's
what's
amazing.
really interesting is I invested in my first note in 2014. So when you think about that, I mean, we have built this massive monthly cash flow that we've never to this day cashed a check. And because we're still working in our real estate business and we don't need the money. So our notes are buying notes every month and they just keep replicating themselves. And we've actually created a perpetual motion machine with notes. So I've got a lot of slides. My slides are very easy to read. So I'm going to go through them kind of fast, especially on the front end of this presentation, which talks about the economy and kind of why we need notes right now and where we are. But this is a question you should ask yourself. What did you do today that you will never have to do again, but will pay you for the rest of your life? So most notes that I do are 30-year long notes. If depending on your age, of course, it might not last the rest of your life, but a lot of people that really start focusing on their IRA accounts are over retirement age, and 30 years ought to be enough. So my goal is to change the way you think about real estate, the way you think about investing. As a young, ambitious investor, I wanted to own everything. Now I don't want to own anything. I want to be the lien lord instead of the landlord, because the landlord gets all the cleaning and the maintenance and the vacancy and the drama of rent collection and everything. The lien lord just gets paid, or else they get the property back and all the down payment. So let's talk about inflation really quick, because our job of providing notes to people just got way easier. The last several years have been very difficult for most people to buy property at a price where they can make a profit, because there were bidding wars on everything. So what is inflation? It's an increase in price that decreases the purchasing power of your money. Money increases demand. Demand causes inflation. So the more people trying to buy something drives the price up. Here's a list of all the presidents of the United States. During the first 232 years, our country printed $8 trillion worth of debt. In 2021, we printed $10 trillion worth of debt. So let me show you what that looks like. This is the money supply. That's how much money was injected into the economy in 1 year, or actually the last couple of years on that chart. So this money supply and absurdly low interest rates during coronavirus, they lowered the rate to, the Fed lowered the rate to the banks at 0, and the banks were offering loans. I have a 2.25% loan on my home. So this huge surge of home buying happened because interest rates had never been that low, and it actually opened doors for people that had never been able to buy a home before. And also the number of second homes sold during the coronavirus, 20 and 21, was 50% higher than ever before in history. So that was a whole bunch of inventory that was taken off the market as a part-time home that kept a full-time homeowner from owning it. So this is what the inflation looked like, and from 2021 to 2022, and it went a little higher than that. This is interesting. Second quarter, 233 million new credit cards were opened, a high not seen since 2008. So when you think about how many people live in this country, I believe it's around 335 million, 233 million. I don't think there's that many people over the age of 18. So pretty much every American on average opened a new credit card in 1 quarter of the year. That indicates that Americans are running out of money. The delinquency rate on those credit cards is increasing. It's now at 7.2. We haven't seen that since the bottom of the Great Recession. So, we're just heading for a lot of trouble, I think. And I'm going to, I don't like to tell people what I think. I like to show them with data why I think that. So this is an interesting article. I don't expect you to read it all, but look at the bottom line. We saw mortgage holders withdraw $39 billion in equity from their homes in the second quarter of 2023. So not only are they running up credit cards, they're piggy banking their house. And now the average house payment in the United States is $2,306. That's up 60% over the last 2 years. How many people do you know that got a 60% pay increase at their job? And now nearly 1 in 4 people that bought a home in July have a home payment over $100 a month, over $3,000. There were only 5% in 2021. Now 25% of people have a house payment over $3,000. So I got a misspelling there. With today's hyperinflation, everything costs more, and people are looking for things that they can cut because they're running out of money. What don't I need? Well, all those second homes that people bought are starting to come back on the market, and 2 million homes were taken off the market since 2009 by Airbnb, VRBO, short-term rental people, and they are now being treated as hotels. So they are no longer being for sale. They're no longer being put up for rent. So those were taken off the market, not counting all the ones hedge funds took off the market during the Great Recession, and that is what caused our inventory shortage between the short-term rentals and hedge funds. So now that everybody's tightening their belt, the biggest discretionary expense that people have in their budget is vacation. So travel is slowing down, and you're starting to see articles popping up all over the place that Airbnb revenue, the worst I've seen is in Sevierville, Tennessee, where Dollywood and Gatlinburg and everything is. We were just out there last week. The Airbnb revenue on the homes there, it's so saturated with Airbnb rentals that the revenue has dropped by more than 50% year over year. So a lot of those people who were making really good money now actually aren't making enough to afford that home. I'm going to show you why they can't afford that home. But when these houses start to come back, and they are coming back on the market for sale and for rent, what is that going to do to home prices and rents? It's 2 million houses. So you don't need to be a rocket scientist like me to see that there are signs of trouble. So this is the median income in the United States back to 1987. Okay, you see the slope of that chart? Now let's look at home prices back to 1987. The slope is pretty much the same. And the interest rate was in 1987 over 10%. In 1982, if those of you who can remember, I bought my first home when it was 18%. But if you look at where we are right now with interest rates, we have not been this high since 2002. That's 21 years ago. So what's interesting is as home prices were increasing, the interest rate kept going lower, and we actually kept almost the same house payment for from 87. Look, it was $1,031, and here in 2012 it was $1,063. So that's what enabled us for 25 years to have house prices just keep going, because people were making more money, home prices were going higher, but interest rates kept dropping, and it kept the payment the same. Now look at what has happened just in the last 2 years. 1369 to 2738. That's what the average American's house payment, that's double. And it's how many people doubled their money in 2 years. There's a question here. Are you presenting slides? We can't see the PowerPoint slides. Nate, can you see my slides?
Yeah, I can see it. Those were questions earlier from my slides.
Oh, okay. I'm sorry. I just had a question pop up, so I'm sorry. And the question is will you have my PowerPoint too? And the answer is no. That actually is, you wouldn't believe the amount of data that I put into this. And I've actually got a conference coming up that I'm going to present all this stuff. And I donate all the money to Make-A-Wish. So I'm not making money. If you want the slides, you can buy them at my conference. And 100% of the money goes to the Make-A-Wish Foundation. So here is the summary of all the charts I just showed you. If you look, I applied rents in here as well. So since 1987, rents, home prices, and income all pretty much hung together until we got the coronavirus, and the home prices went through the ceiling, and then the interest rate started increasing to slow down the inflation, and that has just thrown everything out of kilter. So this is a telling slide. What percent of the income for a mortgage is needed to pay? So back in 87, of the median home price of Americans, which was fairly low, $44,000 is what it is now across the United States. And that's not, most people on this call that have extra money to put into IRA accounts are not in the median, they're above the median. But look at what just happened to the percentage of your pay that needs to go to apply toward a house. It went from 45% to 75% in 2 years. So this is a really interesting statistic. Home prices and mortgage rates are on the rise. So the largest gap in the cost of owning and renting in more than 50 years. So what does that mean? That means not as many people are going to be willing to be landlords, because if you look at the red line, that's the rents, which are fairly static, and except for the last 2 years, rents have increased. But look at the cost to purchase the home that is now being rented. The average cost across the United States is $26.97 a month, and the average rent is $18.45 a month. So there's a heck of a mismatch there, to the tune of $852 a month. So are you willing to give someone else the keys to your house and pay $852 a month for the right to have them in that house, or the privilege of having that person? And this is kind of a cross section for those of you in Texas. Look at Austin. To own a home in Austin, it takes a monthly payment of $36.72, and the average rent is $16.59. That is the biggest mismatch percentage-wise. I mean, the rent paying $16.59, you're paying $2,013, and even in Phoenix, $27.08 versus $15.92. So in San Francisco, this article just came out on September 6th. The average home in San Francisco is being sold for nearly $1,000 below what it was purchased for. So that's just showing that home prices are starting to fall. Economics 101 shows us that low demand and high supply lead to lower prices. So we're getting, and the thing that's holding supply artificially low right now is the people that have low interest loans are not placing their homes on the market. So home prices started to fall in 2019, and then coronavirus propped it up with the low interest rates. And now nobody can get rid of those low interest rates, because over half the people that live in this country could not buy the home that they currently are paying a mortgage on, because they don't qualify for the home they live in. I mean, that's staggering when you think about it. So what's the alternative? In San Francisco, you're seeing a bunch of van lords. This is a row of over 100 people parked on a lake on Binford Road in San Francisco. And people are buying these RVs at auction and then parking them out there and renting them to people on the side of the road. Chris Farley said in 1993, you're going to be living in a van down by the river. Well, guess what? It's happened. It happened in San Francisco. And then in Seattle, same thing's going on. There are 320 RV camps in Seattle, Washington, 414 tent camps. So, man, that's just crazy that people can't afford houses anymore, and they're looking for alternatives. So when prices start to fall, switching from property to paper can insulate you from loss and protect your profit. So if you own paper at the top of the market, while the property starts depreciating, when prices fall, you're going to eat all that depreciation if you own that property. But if you own the paper, the value of your note is only being paid down by the amount of principal that's being paid every month. So in a down market or a receding market, it's time to own paper. When the market bottoms and prices start to appreciate, like who wanted to miss the last 3 years of straight up appreciation? The average home in the United States went up $120,000. So that's the time to own the property, ride it up when it peaks, sell the property, buy the paper, write it down, or sell the property and carry the note and write it down, and then just keep running the cycle like that. So it's not necessarily a set it and forget it. If you want to actively, I'm coming up on 64 years old. I don't want to own anything anymore. I just want to keep the notes. And as I say, my notes are buying notes every month, and I'm not worried at all. And I'm going to show you why, because I'm making far more than inflation is, and I'm outpacing the dollar. And I have mailbox money. I don't have any hassles or people calling me or any vacancies or insurance or maintenance or taxes, insurance, all those bills that come with rentals. So during a down cycle in the market, falling prices can erase your profit. So all the people that made that $120,000, I mean, look, in San Francisco, they're giving $100,000 away just to sell the home that they bought last year. The value of the property doesn't affect the amount owed on the note. So the note stays the same, except for a little bit of principal. So now how do we hedge inflation with notes? The best way is tax-free. If you can avoid taxes, you are going to be supremely wealthy. I'm sure Nate has charts that will show you this is money invested, taxable money, and this is money invested, tax-free money. And at the end of a 30-year period of time, I mean, it's going to be probably 10x if you didn't have to pay taxes on it or more. So the problem is this is what most people have in taxable accounts or real estate or things that they have to pay taxes on. And unfortunately, this is what they have in their tax-free accounts. So what we need to learn how to do is to trade the piles. And we need to make all of our money in the tax-free accounts and very little taxable. So why are tax-free balances small? Because the contribution limits are small, and they can tell you what they are, and most people, because it is so small, don't make it a priority. And I'm going to tell you, this is the most important money that you have, the money in your tax-free account. I'm going to show you something. If you look at $100,000 just invested and forget it at an 8% rate, that amount will be $207,000 in 30 years. But if you look at, that's how much you've earned in the last 3 years. So what this chart is showing you, I apologize, the last 3 years, what if your money wasn't invested for 10% of the time? So in a 30-year period, 10% is 3 years. What if you lost the last 3 years of appreciation? $207,000 is what it costs not to have your $100,000 invested for 3 years. Okay, so your $1 million just turned into $800,000. If you look at a 10% return, it costs you $433,000 just to have your money sitting 10% of the time. This is why I don't like fix and flips, because they constantly pay me back, and then my money sits there earning nothing until I find another property. And each time I have to do all the due diligence over and over and over. So I like long-term notes that I work once and I just get paid for decades. And then if you're earning 12%, it's going to cost you $863,000 not to have your money invested for 3 years of that time, for only 10% of the time. So think about that. 365 days in a year, 36 and a half days out of the year. That's what these numbers represent. Your money not working for you for only 36 days. So how can you finance homes when the most you can invest per year is $2,000, which is a Coverdell educational savings account, up to $7,500 if you're over 50 in a Roth IRA. So what can you buy with home prices $400,000 in this country? What can you fund for $7,500? So the first thing you want to do is merge your accounts. They make them easier to manage. Nate mentioned that he's got a client with 15. My wife and I have 10. And this is kind of what we do with them. We don't have children, but this is what you could put into each of those. If you have a spouse and they each have a Roth IRA, and then you have children and they each have a Coverdell educational savings account, so there's 2 Coverdells at $4,000, and then you're putting in your family HSA every year, health savings account, as Nate mentioned, that is the best investment in the IRA world because they give you a tax deduction to put the money in, and it earns all of its income lifetime tax-free, and all you have to do is spend it on medical, which isn't a problem for most people, especially as they age. So now you form a trust or an IRA or whatever entity your custodian allows you to form. And then if you're over the age of 50, you can increase on the Roth IRAs. If you're over the age of 55, you can increase on your HSA, both $1,000. So you could put in up to $27,000 a year if you're using all these accounts and putting that in one place. It is so much easier to manage and keep it working. It's really hard to keep $4,000 working or $2,000 per account. And it's way easier to find a need for $24,000 by $750. So this is a typical real estate sale. Let's just say that the purchase price of this home is $200,000. Why do I say 200,000 when most people are living in communities that are 400 or more? Find the markets. Affordable housing is where the only place I invest my money, because real estate is like a pyramid. The lowest price homes, the people that make the least amount of money are this wide. And as you go higher in purchase price, what happens is, the pyramid, it gets narrower and narrower at the top. So I want to own homes where the most people can afford them. And actually their payment is cheaper to me buying it than it would be to rent the house across the street. That is my goal when I put these deals together. So now if you go to someone's home and they say, here, the home's worth 200,000, here's the commission, here's the closing costs, repairs, and guess what? Now buyers are asking for closing costs, $6,000, and 2% is pretty normal for repairs. So basically on a full price offer, which isn't happening as much anymore, you would net 178 on your home. So I go to that homeowner and I say, you know what? I'm going to give you 180 and I'm not going to ask for any repairs. So they were going to get 178 by selling it on the MLS and going through all the drama. What if I give you 180 and all you have to do is decide when you want to cash that check? So it's very easy to find people that would like more money and easier sale and pick the day then it's going to close, rather than put it on the market with all the unknowns that are going on right now and the price reductions. So now I can turn around and sell that at a premium. Do I do any repairs on that home? No. The only thing I do is I sell it to someone who can't get a bank loan. Now, a lot of people have the misconception that if they can't get a bank loan, they got to be bad people and they have poor credit. That's not true at all. Actually, we sell to the hardest working people in America, people that own their own businesses and they don't have a W-2. They make way more money than the average person does, but they make it in spurts, and the banks don't like spurts. Somebody that just, like, ask any real estate agent in January, hey, show me your last 2 months of pay stubs. I mean, over the holidays, the real estate market comes to a standstill because everybody's spending money on Christmas and all the credit card bills come in January. So nobody's buying homes in January and it's cold and dark. So this is, very common in the real estate industry that a lot of real estate agents can't get a loan. So because we're offering something that no one else does, these buyers will pay 10 to 15,000 more for a home than you could sell it for on the MLS because of your ability to carry it. So let's look at the profit. If I got a $20,000 discount on the price because I bought a $200,000 home for 180, by getting rid of all the expenses that homeowner was going to pay and actually paying them more for their home than they could have gotten selling it on the open market. And then I turn around and I sell it at a premium to a person who can't get a loan at a bank. I've just created a $35,000 profit. So for those of you who are real estate agents, how many homes do you make a $35,000 profit on, especially $200,000 homes? So, and I'll answer the questions at the end. So I'm going to keep going through this. If you got a $35,000 down payment on a $200,000 sale, that's about 15%. That's a minimum that I'll take as a down payment. And by the way, during the Great Recession, we had 12 million loans in this country fail. Over half of them were subprime. And why did they all fail? The Federal Housing Finance Agency published a report in 2013 that analyzed all those loans, and they found that people that put a 15% down payment on a home had less than a 1% fallout rate during the worst 7 years since the Great Depression. So 15% became my new favorite number, and that's the minimum that I allow people to put down. So now, how long do you think it takes a person to save $35,000 cash? For most people in a job, it's actually over 10 years. So what's the chance of them just walking away from that money? That skin in the game is more important to me than anybody's credit score. So now, most people that invest in notes are older, retired people, and the biggest fear that they have is loss of capital. So I don't allow my investors that invest with me to put ever more than 70% of the value of a home in the deal. So if the home's worth 200,000, I don't let them invest more than 140 max. I like that number to start with a 6, like 67% or something like that loan to value. So now if they're putting in 140 and the buyer's bringing in $35,000 down, that means that there's 175,000. And the second note would be $40,000. So that makes the purchase price the $215 that the self-employed business owner agreed to. And the retirees are getting a 7% rate of return on their money, and which is far more than the banks are paying them. Even the new money markets that finally, after 20 years, are coming up into the 4%, maybe even the low fives. A 7 backed by real estate at 70% loan to value. How many other assets are there that could lose 30% of their value, and you still have all your money and your interest? I mean, I can't name any. So that is the way we structure the deal. 35 down, 140 in the first, 40,000 in a second. You can also do that loan as a one loan and split it. And as Nate was talking about, is your IRA owns part of it and the retiree owns part of it. So now if this is the 35,000 cash, the buyer's coming to closing with 35 cash, the retiree is wiring 140,000 to you from their IRA account. Or if they have an entity like a trust or a LLC that is owned by their IRA account, then they wire the money directly from there. You've gotten $175,000. So that second note is $40,000. If you recall, the homeowner was happier in the clam to make more than they would make on the open market selling that home for $180,000. So now this Roth IRA buys that $40,000 note for $5,000. That brings the price to the seller of $180,000. So we just created a $35,000 tax-free profit in this account with one transaction. So now let's look at the second. The term on that second is $40,000. At this time, I did a 7%. All during COVID, we actually lowered our rates to 6 and 7 because the federal reserve rate went to 0, and we couldn't be more than 6 points higher than the Fed. So we went to 6 on the first and 7 on the seconds. But this is the payment, $266.12 a month. So now we only paid $5,000 for it. So that 7% isn't 7%, it's 63.9% because of that discount that we got on the property. So now, am I worried about inflation if I'm making 63% on my money? Am I worried about how many payments does it take me? If it's over $250 a month, every 4 months I've got 1,000 of my money back, right? And there's only 5,000 invested. So basically, in 20 months, I will have all of my money back, or 19 months actually. So is that sustainable?
Hey, Bob, I got a quick question. It's on that point. So Rodney Dunn, thanks for the question. He says, at what point with lending are you exposed to interest rate laws and being registered as a banking institution, especially when it comes to residential lending? I think he's in North Carolina. He's saying that he believes that you can only do 4 owner finance loans and can't charge over 8%, as he understands it.
So if you look at the nuts and bolts of how this transaction works, we found a seller who wanted to sell the home. That seller is the one that's actually providing the loan. We are buying that note from them at the closing table. We are not originating any notes. So we have no origination. If you read the rule of Dodd-Frank, it said you can originate. We don't own that home. You know, I think of it like this. If you are a homeowner, can you sell your home without a realtor? The answer is yes. If you are not a realtor, can you sell your neighbor's home without a license? And the answer is no. In order to be compensated for that sale, you have to be licensed. It's the same with notes. If you own the home, you can carry the paper. You can't carry the paper on a home you don't own, so you have to have someone else originate the note and you buy it from them at the closing table. Just as most people on the call today have had the loan that they got from a bank, and before they even drove home, that loan had already been sold to somebody else. Does that make sense, Nate?
Yeah, no, it makes sense to me. Rodney, thanks for the question.
Okay, yeah, thanks, Rodney. So is that 63% sustainable? Well, no, it's actually going to be higher. So because in addition to the interest, we're earning, when that note pays off, we're going to be paid back $40,000, not $5,000. So we're actually going to be paid off way more than we invested. So I bought a $40,000 note for $5,000. I got payments 266.12 all the way through. And then every 19 months I got my money back every 19 months for the next 30 years or until they pay off and I fund a different note. So now what if I wanted to take that 63% isn't good enough for me? What if I want to take my small dollar IRA? Because where did I make the money? I made the money on the sale, right? I got the property for 180. It was worth 200. I sold it at 215 and I made a $35,000 profit. The longer I keep that profit in that note, it's spread over more and more time. My return is actually depreciating every year. So what if I season that note and I kept it for 3 months? $266.12 for 3 payments is $798. Okay, so I made almost $800. Now I sell the remaining 357 payments. Do you think there's other people out there who would like a check every month for $2,612? All day long. I mean, retirees right now, especially the people that retired 10 to 15 years ago, they're dying. And man, when you start waving a check like that, there's a line out the door to buy this note from you. And the reason I always say retiree and not investor is investors are going to try to discount you to get that note up to where it's a double-digit return for them. Retirees are comparing you to Wells Fargo, and you are 70 times more than they're making on their checking account at Wells Fargo. So now if I sold the remaining balance, look how much was paid down in 3 payments, less than $100, right? And I already collected almost $800. So now I've received $40,699 in my IRA account. I paid $5,000 for it. So I immediately just injected $35,699 into my IRA account. Okay, that is a 713% return on investment. But wait a minute, return on investment is calculated over a year. This was 3 months. So my real yield on that investment is 2,855%. Nate, you ever seen a return that big?
I'm seeing it right now.
I've got several that are bigger. That's actually infinity.
I've seen them.
Yeah. So, I mean, they're out there. And what I love about this model is who did I cheat? Who did I, screw over and steal their house from? I paid people more than they would have netted on the MLS. I found people that couldn't get a home loan. Most of the self-employed business owners that I funded over the last couple of years have well over $100,000 of equity that they never would have had if I didn't give them the loan, because the bank wouldn't give them the loan. And so the homeowner got a home they couldn't get from anywhere else. The seller got a fast sale, netting them more money than the MLS. The retiree got 70 times more than the interest they're making at the bank. And I'm making $35,000 on an investment that I have less than 10 hours of work in. So this is a pretty cool way to go. So now what if instead of selling the whole note, because once I sell that note, all my money goes away. So what if I just sold it, because I got the recipe now, I know how to make more. What if I just got enough to get my $5,000 back? Because if I can buy another one just like it for $5,000, I don't need all my other money back. So now let's look at this. I sell off 20 payments. So 3 payments that I collected up front was $800. I sold off 20 payments for $5,009.89. And now the payment, I collected 3. I give the next 20 to a person who gives me the $5,000. Now they're fully paid off. So after 23 payments, they're paid off. And when it comes back to me, there's 337 payments left to be paid. So I've been paid now $800 to have, after 23 months, that income stream of $266. They paid me $800 for me to receive $266 for the next 20, or just short of 28 years. So now the return is infinity. And 340 payments at 266 is $90,480. So I had the remaining 337 plus the three I took at the beginning. And that's $90,480 that I made on my 5,000 that was immediately returned to me in a 3-month investment. So that's how you can just accelerate and drive your IRA accounts through the ceiling. So we always made too much money in our real estate business to have a Roth IRA. I didn't even find out until 2014 that the laws had changed in 2012 and I now could have a Roth IRA. So we invested for the first time ever in a Roth IRA in 2014. Here we are in 2023, so we're on our 10th year. I'm proud to say that investments that you could put no more than at first $6,000, $5,500 when we first started. And now this year, because I'm over the age of 50, I can put in $7,500. But when you add that up over 10 years, I mean, the most I could ever put in is not even $70,000. It's now actually over $1.2 million. So just doing this. There's no limit to the options available. So your decision to sell depends solely on the goal you're trying to achieve. As you know, I would always say, keep your money working until you find another opportunity for it. Don't ever let it sit around. I told you, just 30 days of sitting around will cost you hundreds of thousands of dollars over a 30-year period of time. So you don't find deals with huge yields like this. You make them, you create them. So I don't fund notes that I don't have a hand in structuring. It's on someone else's property, but I basically make sure that the buyer has adequate down payment, that the buyer is qualified by a licensed loan originator as required by Dodd-Frank. So now it's somebody with a loan license saying that that buyer had the ability to repay. So now here's an example of, these are 4 real-life examples of notes that we funded. This was a $135,000 note, $135,880. This is a house in Dallas, Texas. When we got that note, it was from someone, a flipper, and we basically were able to get that note from them at a discount because they had their profit built in. So they sold it to us for $118,267. We sold a partial, and at that time I didn't even change the interest rate. I gave the people that bought a partial from me the same interest rate I was receiving. So now I have $23,000 invested, and at par they're getting the same amount of interest I am. I was making $357 a month, $4,292 or $4,292 a year, which is 18.5%. So now that's going to take me 5.4 years to recover my money. Is that a pretty good investment? Even giving it to someone else who didn't do any of the work at the same amount that I received, I can still make an 18% deduction because of that discount. And most of the time when you see that discount, what it is it's offsetting what would have been paid in real estate fees, what would have been paid in closing costs, what would have been paid in repairs on that property. And I sell it to a contractor who is in the trades and is going to repair it themselves. So I don't have to make that repair. And again, I don't ever own the home. The seller of the home is saving the repair money, saving the buyer's closing cost money, and getting a faster sale. And with all that, they're actually netting more than they would have gotten anyway. So 18%, I'll take that return all day long. So can you do better? Sure. Here's another one we funded, 121.5, discounted 18,274. Got it funded for 103,225. Sold a partial at 9%. Finally got smart and said, you know what? I did all the work. I should make a little bit more than you do. So now I'm selling off $89,000 of it. I'm going to make 1% on their $89,000 and 10% on my $13,000. So I have $13,770 left invested in this note. Because I'm getting part of theirs now, my payment is $347 on a $13,000 investment. So I'm every 4 months getting $1,000. So I'm getting $4,000 a year. That's a 3.3 year recovery, right? Once I figured this one out, it's like, you know what? I don't want to invest in anything anymore that doesn't give me my money back. A lot of people focus on ROI, return of investment, or return on investment. I look at return of investment. If I put my money into this, how long does it take me to get it back so I can invest in something else and still keep the return on this? Okay. So now this third note, this is all in the same account. 10% note at 81,000, got a discount 31,434. This was a wholesale deal that the person couldn't take down without that $81,000, and they got it really cheap and at a discount, and we funded 49,565. Sold a partial on that note at 6%, and that was during COVID. And again, compare that to what people are earning at the bank. 6% is awesome, 60 times more than the bank was paying on the 1% on checking account deposits. So now we actually got paid. And again, because this property was sold at such a, the buyer bought it at 60% less repairs. So they had the equity in it, but they couldn't do the deal without us helping them. So we funded that deal. It was turned around and resold as a note and to a person that fixed the house up. So now we got paid $19,000 to receive $284 for the next 30 years, every month. So $3,400 a year, got paid $19,000 to do it. That's an infinite return, or infinity. And then the last one was a note at 9%, a small one, $35,000 note, no discount. It was just $35,000 that we funded at 9%. So now I sold a partial at 6%. They paid $32,965. Again, this home is worth like $90,000. And this was a tired landlord in Alabama that was just selling off all their inventory. And actually, one of my coaching students had this note, and she needed 35 grand for the note. And, I funded her the $35,000, and the loan to value on it was less than 40%. And then I sold 32,900 of it. I kept 2,000 of my IRA money in there. And then I get a $78 payment every month, $944 a year. So is that going to make you rich? No, but if you only got an account, like a Coverdale educational savings account, this is, a 46% return on your money that you're putting away for your kids' education, and a 2.1% recovery time. So if we look at that and we add up all four of these, you got the first note making 18.5, you got the second note making 30.26, you got the third note making infinity, and the fourth note making 46. So my average yield on all of these notes is 64.9%. What does the rule of 72 tell you? Whatever rate of return you are, divided into 72, tells you how many years it's going to take to double. So I'm doubling my money about every year and 2 months. So, if you think about that, a year and 2 months, a year and 2 months, a year and 2 months. So 6 years, or 6 doubles would basically be 7 years. And it's going to double 6 times. So 100,000 would be doubled 200, 400, 800, 1.6, 3.2, $6.4 million is 6 doubles on $100,000. So if you multiply the annual income of 30 years, these notes that I funded a total, when you look at what I have invested, I have $19,599 invested. It is going to pay out $384,480. So is that enough to offset inflation? And I would say, yes, it will. So everybody that's worried about, notes are depreciating assets. They are depreciating. That's a good thing. Every month, you're owed less money. That means your loan to value ratio is actually declining. Even if the property value is declining, the loan is declining too. So it keeps your risk the same. If you are giving interest only loans and the market starts falling, then your risk loan to value ratio is increasing and your risk is increasing. So I would not recommend interest only loans in this market. And a lot of flippers out there are having a hard time selling their homes. And those are the guys that want the interest only loan. So it's getting worse and worse for them and for you every single month. So again, this is the bottom line. You get your money back every 19 months for the next 30 years. So now let's take $1 million. If you were going to try to get your IRA account to $1 million, it would take 1,000 deals that make $1,000, 200 deals that make 5,000, 100 deals that make 10,000, 50 that make 20,000, and 20 deals that make $50,000. So that's a lot of work trying to find $50,000 deals, and also you need 20 of them. You can probably find $20,000 deals, but you have to do 50 of them, right? So if you look at my $1 million magic, all it takes with me is 3 deals that make $35,000. So now I invest that $100,000 profit at a 26% yield, which I just showed you is extremely possible. I mean, I'm doing 3 times that. Let's compound the interest, or let compound interest do the rest. Nate, how long do you think it's going to take me to reach $1 million if I'm making 26%?
It'll be pretty fast, especially if you're compounding the interest. And the other thing I was going to say is how many of these notes pay off early, and what's that do to your yield?
When they pay off early, if I had that big discount, it cranks the yield through the ceiling. And I don't ever penalize anybody for paying me off early. If they want to pay off early, that's doing something good for their family. I can find there's so many people out there. I do these notes in my sleep. I actually find them every week. I mean, on my weekly webinars, on my Zoom calls. I mean, we have a lady in Alabama, a doctor that just bought an 11 home package for $550,000 from a tired landlord, and we're basically putting notes on all of them and selling them, and she's finding contractors to purchase those homes. Her average cost to buy them was $55,000, not even that, $50,000 per house. So
can I ask a couple questions? We got a couple good questions, and you kind of mentioned it. Tired landlords is one source of where you're finding some of these deals, but Ramses and Helen and Vishal, thanks for the questions. They had questions relating to where are you finding these deals, and where are you also finding the retirees that are investing in these deals? How are you structuring your network, and how are you getting this deal flow?
So the deals are anybody that wants to sell their house. And as I said earlier, right now that has gotten far easier because everything isn't selling on the first day with multiple offers. There's actually price reduction. So if you look at people who have been trying to sell their home for a long time, you don't have to be a realtor. You can go to Zillow and look at the price history of a home and see that, hey, this person's lowering the price regularly. And so this is the person that you would approach and say, I would like to pay you more than you're asking for your home. And that will get their attention and definitely get you the appointment. And then you sit them down and show them. And, the first opportunity would be for them to do the heavy lifting and do the carry. And especially if it's a landlord, because the landlord is going to pay a huge capital gain tax if they sold that property outright. But if they carry it as a note, it actually becomes spread over 30 years. And even though, yes, they're going to pay tax on the profit, they only pay on that profit as they receive it. And they're floating the IRS for 30 years. So those two, I mean, anybody trying to sell a home that's struggling right now is a good candidate for this. And any landlord that just wants out is another good candidate. And then as far as the retirees, money comes with trust. You don't buy trust, you don't sell trust, you earn it, right? So the people you already know, especially if you're a real estate agent, you have all these people that have already trusted you to sell their home. So it just became part of my repertoire. And again, I either am a real estate agent representing them or I'm a note investor representing me. I can't wear 2 hats at the same time.
Right.
But real estate agents and investors do exactly the same thing. We find buyers, we find sellers, we structure deals. Real estate agents do it for someone else. Note investors do it for themselves. So,
and I'll say this too. I'll add this for anybody that's new to this. I'll say I've seen it over my 11-year career is when you start getting creative with some of these deals, and like Bob said, you're building trust with somebody. A lot of times, the hardest investor to get, and tell me if you believe in this too, is the first one. The first investor that you get is usually the hardest one. But once you make that person money, once you've earned their trust, it becomes easier and easier because they recommend you to people. So it kind of spider webs out from there. But I always see people struggling with that first investor. After that, after they've shown their value and show that they can make their investors some money, it usually spider webs from there.
Yep. Yeah, it's rinse and repeat. It's a known quantity. So let's look at this 26 per year. The first year, you're going to make 26,000. The second, you're going to have 158,000. The third year, you're at 200. So the rule of 72 says 26 into 72 is about 3 years. Look, it works. It's actually not the rule of 72. It's 52. The rule of 78 works really well on this one. So now in the second 3 years, we double again to 800 or to 400. In the third 3 years, we double to 900. And now we have reached $1 million at 10 years. So you started with 3 deals with $5,000 and you use the same 5,000 over and over again. So you're in this for $5,000, right? $1 million in 10 years. So how many people in corporate jobs make it to $1 million in 10 years? They're on the 40-40-40 plan. You work 40 hours a week for 40 years, and then you end up getting 40% of your paycheck when you retire. That's what the average American does. So what is residual income? A consistent source of income that requires minimal to no effort to maintain, just an upfront investment of time, money, or both. So that's what these notes are. You put the time in up front, you do your due diligence, you put all the moving pieces together, and then you sit back and collect checks. So this has caused me to change my lifestyle. Basically, we have spent 12 of the last 16 weeks in our RV traveling America. We put on 20,000 miles since we purchased this diesel pusher last April. And since COVID started, we've put on 40,000 miles traveling the United States and teaching investors all over the country how to do this. So that makes my travel tax deductible. It's another good thing. So this is our home most of the time. I mean, a third of the year. We almost always stay on lakes. There's the 3 dogs. There's my wife. That's what my backyard looks like most of the time. And this is a place in Oklahoma that one of our favorite RV parks, because every day at 5 o'clock, this little gal brings us margaritas. So if you want to learn how to work smarter and not harder, start helping people, live to give. When I started incorporating charity into my business, that is what happened to my results. And I have a conference coming up. I only do this one time a year. It's actually, the date on this one is wrong. I'm going to change that. Is October 6th and 7th of 2023. And there is a code. It's notebusinessbuilder.com. If you type in the code $300 OFF, so $300 OFF. And for those that can't travel here, I highly recommend you travel. You see this little board in the back of the wall? That is a deal board where people with money are looking for deals and people with deals are looking for money. So I will broadcast it over Zoom, and you can buy the recordings over Zoom. And again, 100% of the money goes to Make-A-Wish. So give that again, notebusinessbuilder.com. If you want to learn about this, I actually wrote this book in 2008. It's by far outsold all my other 5 put together. And it is basically educating. It educates the retirees for you. So basically, it teaches them that they can be a bank. And when it first came out on Amazon, it was #1 for 3 weeks. I was ahead of Robert Kiyosaki. So, and then if you want to listen to what's going on in the market, this is my on iHeart. You can just go out to podcasts and you can hear my show every week. Back in coronavirus, we got nationally syndicated. And I have a weekly coaching call, and basically I have over 400 webinars I've been doing this since 2015, teaching people how to do this. We funded thousands of notes on these webinars every week. And back to the first question, what did you do today that you'll never have to do again, but will pay you for the rest of your life? So, Nate, I'm going to offer everybody, if they want to jump on my next webinar, just send an email or text me. My information's at the bottom of the page. And that is all that I have for today.
Well, thank you so much, Bob. That was great. I'll tell you my own personal experience. I've learned a lot reading Bob's book. I've seen Bob's presentations. And the reason why I want to bring him on here is he does a lot of education. Never on these programs are we going to bring anybody that's going to sell you investments. But a lot of the people that are on here provide very good education. Bob's one of the guys, at least in the note industry. He's very well respected. He's got the podcast. He's got a lot of different things. He's got the event, if you can go to the event. But I think, especially with self-directed IRA investors, the more you can get educated, the better an investor you are. And it's just great. And Rodney, I want to thank you for your comment. He just talked about how he's excited about some of our education, and thanks for doing this. And he's going to follow up with us. So, Bob, any last minute thoughts? I've got a couple questions on here. Ramdes, I'll have him catch your question. He wanted to ask about the $200,000 house, and I think I know the condition of it. But he said, "What was the condition of that $200,000 house?"
It's the nicest house on the block.
That's what I figured, because you didn't even have to do
Because I'm
rehab.
going to people that are trying to sell a house, an MLS house. This is not a wholesale deal. This is a person, mom and pop. My favorite home to put a note on is grandma's house. It's been gently lived in and kindly taken care of all these years. It's just very dated. And that's what the contractors, can see the benefit of, is going in and replacing that old, wallpaper and vinyl flooring and making it modern. And so these homes are very, very good condition. I don't want to buy myself a job, and I don't want to get that house back. So we fund those. And then Helen asked, what's the smallest note investment? I mean, you can invest as little as you want, as long as the other person is willing to invest, with you. But so the bottom line is it's a symbiotic relationship. What do you bring that the other person needs? And then also the question about, if people are struggling now, how will they pay the notes going forward? This is why I no longer invest in Arizona. Our home prices went from 160, which was the average note or purchase price I was funding back in 2012, to over $400,000. So this is why I like Texas. I like Alabama. I like Arkansas. I like North Carolina, because you can still get affordable homes for under $100,000. And those people, the payment they're making to you is going to be about $300 a month less than they would pay in rent. So that is what's going to keep me paid during this whole 30-year period of time. Is the choice of not paying me means they move across the street and pay the other landlord more than they're paying me, and they have no ownership or none of the tax benefits of doing it.
What was the code again, Tom, Bob, for your
$300 OFF. So I'm going to go ahead and type it in so everybody can see it.
Go ahead and type that in. One thing I want to bring back too, Bob did mention the trust. Now, we do set up a lot of our clients with the IRA owned LLC. That's another way that you can go. A trust was one option. But I think that was an important thing that we kind of talked about a lot earlier in the program, is if you've got multiple IRAs and you want to start investing into deals, a lot of times, regardless of the investment, it helps to have some sort of entity where you can dump all your funds into, whether it's Roth for you, Roth for your kids, Roth for your spouse, your HSA, and just get them into one central bank account that you have a little bit more control over, you can access. So if you have questions on the checkbook IRA LLCs, we're professionals in that space. Just shoot me an email, and I'll put my email in the chat if you guys want any questions. And I apologize for my slides not showing, guys. I apologize. I was showing the wrong screen. If you want my slides, just shoot me an email and I'll send you the slides to my presentation as well. So, Bob, anything else you want to add?
Well, just if you have questions, I mean, there's my contact information. Everybody has a limited amount of time, and the best use of it is to do something to benefit your family. So if there's a small question, I can answer it, but I would highly recommend 2 days in the trenches of doing what I do. And I had to cram 91 slides into 45 minutes today. So just think of what it would be like for 2 days of slowing it down and let you absorb it and then role playing it. And that's what we do at the conference. So we're going to talk about lead generation and how to find the people and the money and to earn the trust. And there's a couple more questions. It has to be self-directed to invest in real estate. So yes, it won't work if your money's sitting in Fidelity or your company's IRA account. So you call Nathan and figure out how to get that rolled over into his account. And then if you want tax-free, you can always do a backdoor Roth before they go away. I don't know when they're going to take it away, but that's what we do every year, is we put money into a SEP, and then the 2nd of January, roll it over. And the reason I say the 2nd of January is because it's not taxed until April 15th of the following year. So just strategies like that can save you hundreds of thousands, if not millions, in taxes over your lifetime. And yes, Elena, if you have a home with a 2.49% mortgage, do not sell it. Sell it on a note and do that. I actually sold all of our rentals that we had in 2021. I refied them all at 3.25%, and I turned around and sold them all and carried the paper. I'm now making more money on those rental houses that, now that I don't own them, than I ever made in my life. So 400 to 600 a month profit on the money. So just
Great point.
the answer is always no if you don't ask the question.
If you guys can see my screen, there's my email address. And if you want to talk more about setting up a self-directed IRA, if you're new to this, or you want to talk about rolling over an old IRA or old 401k, just scan that QR code there. You can book a call with me. You can also find this on our website. Just go to our website, directedira.com, go to the book a call, go to the bottom. You'll see me there. I love to talk strategy with you guys, so we can talk a little bit about that. And then last slide is, if you want to learn more about self-directed IRAs, we're going to be in Raleigh. This is the first time we're going to be bringing this event to the East Coast. It's going to be a phenomenal event. It's October 20th and 21st. It's really a one-day event on the 21st. The 20th is just a welcome reception. But if you guys want to get tickets, there's only about 50 tickets left to this now. This is our 10th Self-Directed IRA Summit. Use the code NATE50, and that'll get you $50 off GA tickets or virtual tickets. Okay, NATE50. So VIP is almost sold out. So we still have a couple there. But if you guys are interested in a one-day crash course on self-directed IRAs, or you just want to network with like-minded investors in the North Carolina area, you should be at that event. So just go to scan that QR code or go to SDIRAsummit.com, buy a ticket, use NATE50, you get $50 off. Awesome stuff, Bob. I hope I see you. I might see you at your event. I'll talk to you about that offline, but I really appreciate you sharing it. I think we got a great feedback, and everybody's saying thank you. So I really appreciate your time.
Sure, not a problem. Thank you so much for having me on, and hope you can come down here. It'd be great. I'd love to have you give a presentation the second day if you can.
Definitely. All right, guys. Thanks, guys. Have a good rest of your Tuesday. Have a good rest of your week, and I'll see you guys on the next program.